You're watching Silver News Daily. Subscribe for more.
Industrial mining goes downhill. It goes into recession when the economy cuts back. And so silver production from really about half of the new source of silver also gets cut back. And so that's why I think that if the gold-silver ratio is indeed an indicator of recession, economic contraction here, that's the reason why you see the gold-silver ratio very often, once it peaks, it reverses course very quickly in the other direction.
You're about to hear a prediction that sounds completely insane until you see the data. Silver hitting $500 an ounce? That's not just some internet rumor. It's a very real possibility, and the fuse is already lit. Inflation is chewing through the value of the dollar, tariffs are shaking the metals markets, and the threat of a global recession is closing in like a storm. But here's what almost no one realizes. These three forces aren't acting alone. Together they're triggering a once-in-a-generation supercycle in silver. And when this thing ignites, we could see price moves so violent they'll make the 2011 silver spike look like a blip. You might think it's too late to get in, but the truth is, we're only just getting started. So how does a forgotten metal buried beneath the shadow of gold suddenly become the centerpiece of a financial earthquake? Let's dig into the signal that has every expert whispering, this might be the moment silver finally breaks its chains.
It's historically important that gold has been so strong in the marketplace, and silver's been lagging. I know a lot of people complain about silver, but silver's up significantly as well. It's just that gold has been doing so well, I guess primarily because of central bank buying of gold. But the gold-silver ratio is a big indicator of telling us what's more expensive and what's less expensive. And the idea that, the gold-silver ratio is over 100, meaning that for 1 ounce of gold is equivalent to more than 100 ounces of silver. That just doesn't happen. I mean, historically, the old ratios were 10 to 1, 15 to 1. In the modern era, it's been averaging more like 50 or 60 to 1. So the idea that it's over 100 to 1, I think is historically important. And it's also an economic indicator. Obviously, both metals are doing extremely well. Both metals have been moving up now for multiple years. And so I took notice of the gold-silver ratio getting over 100. It's still about 100. And so I started looking at that. And one of the things that I found was that very often that very high ratio is associated with a looming recession. But also I stumbled onto the notion the investor notion that not only is gold very expensive, but that it might be a good time to switch from gold to silver. And so I did a couple of experiments. I traded some electronic gold for some silver gold, and then I actually traded a gold coin for silver rounds, just to go through the process, see what it was like, see if there was any surprises in the whole thing, because I think it's from an investor's point of view, from my personal point of view, it's a really good deal.
The warning sign is already flashing, and it's coming from the gold-silver ratio. Right now, that ratio is sitting between 90 and 100 to 1. Historically, that's a massive red flag. It means it takes nearly 100 ounces of silver to buy just 1 ounce of gold. And every time this ratio climbs to these heights, a recession tends to follow. But here's where it gets interesting. During economic downturns, gold usually moves first. Investors rush in for safety. Silver, on the other hand, tends to lag behind at first because it's so heavily tied to industrial use. But once the fear sets in and the economy begins to contract, something flips. The mines slow down, production drops, silver supply starts to dry up. And when that happens, silver doesn't just play catch-up, it explodes. And take 2020 as the perfect case study. The gold-silver ratio spiked past 120. Then silver roared from just $11 an ounce to nearly $30 in a matter of months. Not years, months. That move wasn't driven by hype. It was a textbook response to economic chaos and tightening supply. And guess what? We're seeing the exact same setup again. The ratio is telling us the market expects turbulence ahead. Investors are already piling into gold. But silver, it's still being ignored, still trading at a discount that makes no sense when you look at the fundamentals. And that's why this isn't just about the ratio. It's about what comes next when the market wakes up to silver's true value.
Well, I mean, that's a possibility. It could be a new normal, and the gold-silver ratio could go to 110 or 120, and I would probably switch even more rather than less. And so it could go ever higher. I think it's been as high as 120 at one point, but that was a very short period of time. And, that's, once you get past economic theory, the idea that the government's spending, it's borrowing, it's going to have to print, and therefore precious metals, real money, is going to be valued higher in terms of the fiat paper money. Once you get past that, you're more or less, you have to rely on historical information. That's what all forecasters are relying on. That's what every indicator relies on, is historical past experience. I've never come across any indicator, even the Super Bowl indicator, financial information indicators. That's all past data. That's all history. That's all we have to work on once we get past theory. And, that's one of the things they teach us as Austrian economists, is that we don't know when things are going to happen. We don't know how much things are going to change, what the numbers are actually going to be. We can't actually forecast in a very precise way. And that's why everybody must rely on historical information, play the odds. I'm a value-oriented person, and that seemed to make a lot of sense to me. And of course, I also don't go all in on everything, with all my money or with all my, perspective on something.
Industrial mining is the quiet backbone of silver production, and it's already starting to buckle. Here's what most people miss. Nearly 70 to 80% of global silver supply doesn't come from silver mines. It comes as a byproduct of mining other metals like copper, lead, and zinc. And during a recession, these base metal operations are often the first to shut down. Demand for copper drops, zinc projects get shelved, and with them, silver output quietly collapses. Not because there's less demand for silver, but because the infrastructure to extract it just disappears. That's the hidden danger. Silver supply is incredibly vulnerable to shocks in the broader industrial sector, and right now, all signs point toward a slowdown. But this isn't just theoretical. We've already seen the consequences. Global silver production has been flat for nearly a decade, with some years even dipping lower as reserves dry up and operating costs soar. In 2023, mine output was around 830 million ounces, a number that barely covers rising industrial and investment demand. Now, factor in the recession signals flashing from bond yields, tech layoffs, and contracting GDP forecasts, and you have the makings of a perfect storm. When industrial mines go quiet, silver dries up fast. And with no way to ramp up primary silver production quickly, the market is left gasping for supply just as demand begins to roar back. This is where silver's volatility works in its favor, because when scarcity hits, prices move fast and they move hard.
I do, balance the odds and have a careful outlook on what's going to happen in the future. So yes, the gold-silver ratio could go even higher. But based on everything we know and what we can rely on, the gold-silver ratio is at a high point, and those things tend to turn around very quickly, and there's a good reason for that. I did a podcast episode on the silver lining, why silver behaves the way it does. Why does it seem to catch up? Well, the reason, theoretically, and in fact, is that when we go into a recession, that's when gold tends to reach its relative peak, and that's when silver tends to catch up. The wild dog catches up with the mama dog, in a sense, and then surpasses it. And why is that the case? Well, about half of all silver mining comes from, and remember, silver is something that, is mined, it comes to the surface and it's put to use by and large. Whereas gold, it comes to the surface and it stays in use. It's not disposable in any sense. So with mining silver, 50% of all silver comes from industrial mining. And so industrial mining goes downhill. It goes into recession when the economy cuts back. And so silver production from really about half of the new source of silver also gets cut back. And so that's why I think that if the gold-silver ratio is indeed an indicator of recession, economic contraction here, that's the reason why you see the gold-silver ratio very often, once it peaks, it reverses course very quickly in the other direction. And that's the theory behind why that happens.
And that's where the trap gets set. Because while supply is poised to collapse, demand isn't going anywhere. In fact, it's growing. Unlike gold, which is mostly hoarded, silver is consumed. Once it's used in electronics, solar panels, electric vehicles, and medical devices, it's often lost for good. And here's the kicker. Demand from these sectors isn't just steady, it's accelerating. The global push toward electrification and decarbonization is swallowing silver at an unprecedented rate. Let's talk solar. In 2025 alone, solar panel manufacturing is projected to consume nearly 200 million ounces of silver. Why? Because silver is the most conductive metal on Earth, and there's no real substitute for its efficiency in photovoltaic cells. EVs are no different. Each one uses up to 50 grams of silver in components like batteries, inverters, and charging systems. Multiply that by millions of units per year, and you're looking at another major silver vacuum forming under the market. Add in 5G infrastructure, medical tech, and consumer electronics, and it becomes clear, demand is not only inelastic, it's insatiable. And here's what makes this explosive. These industries don't care about silver prices, whether silver is $25 or $250. They need it to keep their factories moving. This means industrial demand is price agnostic, and that's rare. When you combine that with falling supply, you're setting the stage for one of the most violent repricings the metals market has ever seen. Investors still focused on gold have no idea what's building beneath silver. But when the crunch hits, this market won't wait. It'll reprice in weeks, not years.
I'm anticipating a recession in the economy. I'm anticipating the stock market doing much poorer. We've been in a very long bull market. The unemployment rate has remained below the full employment rate level, which is a leading indicator of the economy turning around, going into a recession, and the stock market turning bearish. And so we've already got that historical background of a booming, very long-term boom in the stock market, and particularly in the NASDAQ and the technology stock, the artificial intelligence stocks, and that sort of thing. And we've had an unemployment rate very low for a number of years now. And so those are the preconditions. A boom is a precondition for the bust. And so it's perfectly logical to anticipate a bust in the economy. And this is the President Trump's tariffs. That's really beside the point. That's a different issue. Tariffs are not about inflation in the business cycle. That's either you're making yourself poor with tariffs or you're making yourself richer with free trade. So that's a separate issue entirely from the work that I do. And so, yes, I am anticipating a recession. And given that the unemployment rate has been so low for so long and the stock market has risen so high since the last bear market, I anticipate that things could be very severe. And that would, again, push the gold-silver ratio in the other direction. That would be the push off of the ledge.
While industrial demand is surging and mining output teeters on decline, another force is quietly keeping silver suppressed, the central banks. But not in the way you might think. See, while investors obsess over what the Federal Reserve or the ECB will do next, central banks themselves have been laser-focused on gold, not silver. In 2024, central banks bought over 1,000 tons of gold, a record haul, and that buying spree hasn't let up in 2025. Countries like China, Turkey, and Poland are stuffing their vaults with bullion, creating massive upward pressure on gold prices. This is what's keeping the gold-silver ratio elevated. But here's the opportunity. Silver isn't part of that race. It's being overlooked, forgotten, and most importantly, undervalued. Central banks aren't touching it, not because it's useless, but because silver doesn't serve the same monetary role in their strategies. That leaves silver in a strange position. It's being compared to gold in investor circles, but without the institutional demand to move its price in the same way. And that's exactly why it's still affordable, why it's still trading under $35 while gold rockets past all-time highs. This divergence is what savvy investors are watching, because eventually the ratio has to correct. It always does. And when it does, it won't be central banks driving the price. It'll be the private market waking up. Retail investors, industrial buyers, and hedge funds all chasing the same shrinking supply. Gold's rally may dominate the headlines, but silver's quiet neglect is what makes it the more explosive bet. The deeper the gap grows, the more violent the catch-up becomes. And when the market rebalances, it won't do it gently. It'll do it with force.
Well, the gold-silver ratio tends to peak right before a recession. And then it follows the course down through the recession and gets reversed eventually. And of course, once you go into a recession, once the stock market retreats, the Federal Reserve is going to be cutting interest rates. And my anticipation is that we're going to get several interest rate cuts once this starts to materialize. I know that the Fed officials in market, Wall Street, all that, they're looking for one or two cuts. I think that's wrong. I think that once the real state of the economy is revealed, the Fed is going to be forced to make a number of cuts. And the only thing that's holding them back really is the fact that interest rates and the need to finance the tremendous government deficits and the national debt is crimping their style. And we recently saw a real setback in the funding process for the federal government that kind of spooked the markets when interest rates on the 10-year bond went up unexpectedly in a jerky sort of fashion. But with respect to 2020, 2021, I think we have to take everything that occurred in that period with a grain of salt and not try to base our analysis on that period necessarily, or try to fit our analysis to that period, because you have a very, very unusual circumstances that have never really happened before, where the government simply shuts down 1/3 of the economy, and where the government, borrows an additional $5 trillion, and where the Federal Reserve makes another $5 or $6 trillion of funding available. So everything that occurred there was so influenced by the COVID response by government that we don't want to rest our laurels. We don't want to base our analysis or our investments on what happened during that period, because that takes our eye off of the long-run theoretical results that we know are true about government spending and Fed money printing and all of that. So I try to not eliminate that from my analysis, but I don't want to place too much emphasis on that as well.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active. Now layer inflation onto this already fragile equation, and you begin to see the full picture. Inflation doesn't just eat away at cash, it ignites the precious metals market. And while everyone's watching gold respond to rising prices, silver's response is far more aggressive when it finally kicks in. The reason? Silver doesn't just hedge against currency devaluation, it does so while also riding a wave of industrial necessity. That dual identity turns it into a loaded spring. Let's be clear, we're not in hyperinflation territory, but we don't need to be. Even modest inflation, when persistent, acts like a corrosive drip on fiat currencies. With the U.S. national debt ballooning past 125% of GDP and trillion-dollar deficits becoming the norm, the dollar is under constant pressure. As confidence in paper money wanes, hard assets become the lifeboat. And silver, often called poor man's gold, starts to look very attractive, especially when gold becomes too expensive for the average investor. But silver's inflationary surge has a different flavor, because while gold demand may rise due to fear, silver's demand rises from both fear and function. Factories still need it, panels still require it, vehicles can't roll without it. So even in an inflationary environment, demand doesn't contract, it expands. And here's where it gets dangerous for the bears. If inflation accelerates or expectations shift upward, silver could spike violently, not just from investor panic, but from supply chains scrambling to secure material at any price. This isn't just about wealth preservation, it's about survival in a market where scarcity meets necessity under the crushing weight of a falling dollar.
I don't anticipate this downturn, no. I mean, the first and only time that I ever spoken about hyperinflation was in 1995. It was at a gold conference, and people were making their predictions for gold being $900 or $1,000. And I said, well, my prediction is that the price of gold will be infinity because the value of the paper dollar will reach zero. But the time period on that can be decades and decades and decades long. And we're 30 years into that. And I think my caution on that particular prediction was correct. But I think we're very, very close. And that's why for the second time in my entire life, I talked about hyperinflation on the Minor Issues podcast a couple of weeks ago, because I think we're making that turn where we're really getting to the point where the national debt and the annual deficit in the government's budget and the ability to finance that, because right now our foreign investors have pulled back in terms of investing in government bonds pretty much across the board. And the domestic economy is also one that's not, just oozing forth with additional savings by Americans who want to buy 10 and 30-year government bonds. And so it's getting to the push against shove aspect. But the big thing about the hyperinflation of the U.S. dollar is the U.S. dollar is, a friend of mine put it this way, it's the least dirty shirt in the laundry hamper. And so it's the best paper money out there because the U.S. economy is so big and we have such an intimidating military presence. But I think now, in the past, certainly in 1995, in 1965, in 2015, the dollar was the solid world reserve currency. It was the solid world trading currency. It was the most stable of the fiat monies in the world. But I think now the U.S. is backing itself into a corner. And if there was ever a need, or even if there wasn't really much of a new need, like an emergency or a war, we're in a precarious funding situation. The interest on the national debt is now the largest outside of Social Security. I guess it's the largest single expenditure. And so the U.S. national debt is now 125% of gross domestic product. And historians have found that anytime a country gets into where their national debt is 100% of gross domestic product, it enters a spiral from which they can't get out. And so
And just when you think the setup couldn't get more combustible, enter the tariffs. Economic policy isn't just about taxes and trade, it's a wrecking ball in the metals market. And silver is right in its path. In 2025, sweeping tariffs on base metals like copper and aluminum threw global supply chains into chaos. Prices surged, imports stalled, substitutions began, and one metal quietly started stealing the spotlight: silver. When tariffs choke off access to key industrial metals, manufacturers scramble for alternatives. In many cases, silver steps in not because it's cheaper, but because it's better, more conductive, more versatile, more available, at least for now. And this isn't just a theory. It's already happened. Back in April, silver prices spiked to $35 an ounce on the heels of new tariff announcements, only to plunge below $28 days later as markets reacted to retaliatory moves from China. That kind of whiplash isn't random, it's volatility triggered by policy, not fundamentals. And that's what makes it so dangerous for unprepared investors. Because while Wall Street analysts argue over long-term trends, the real market is being moved by immediate disruptions, policy decisions that change demand dynamics overnight. What we're seeing now is a warning. Tariffs are back on the table, and the next round could hit harder, especially if the global economy keeps fragmenting. The more governments weaponize trade, the more markets scramble to adapt. For silver, this means wild price swings, unpredictable moves, and sudden demand spikes that the current supply structure simply cannot absorb. Every new tariff is another crack in the dam. And when it breaks, silver won't just rise, it'll erupt.
We're going to see. And I'm not happy about it. I'm very perplexed about it. I'm kind of angry about it that very few people are even talking about it. And even Secretary Bassett, kind of dismissed the idea that the U.S. lost the last of the 3 AAA bond ratings. And he kind of dismissed that as, that's Biden's fault, or, it hasn't changed anything in the last 24 hours and, things of that nature. This is a very serious problem. We're in a spiral and it's going down. We could reverse it with the right policies, but there is absolutely no indication to me that anybody in Washington, D.C. has any interest in doing anything about it. So I think we all have to be prepared that we're going to continue down the spiral. And this is essentially a toilet. This is not, some playground game spiral. This is serious business. It could mean a drastic reduction in our standard of living. It could mean various types of civil chaos, frankly, because high rates of inflation. We experienced a short period of 9% increases in the consumer price index, and it had a tremendously negative undoing in many family budgets across the country that they still haven't recovered yet. So, we're talking easily going beyond those type of levels with the tariffs, with the lower value of the U.S. dollar. It's now below, I think, the dollar index is below 100, and I anticipate that going much lower. And that means higher prices. That means that we're going to be paying more for imported goods, again, irrespective of any tariffs. And we're also going to be paying more for everything that's produced and sold on an international market, like energy, raw materials, things of that nature. Those prices are going to go up. Even if we produce them domestically, these things are set at world price levels in terms of dollars. And if the dollar goes down, those prices go up, and the impact is that our real income is going to go down. And, these things are converging, and they're all converging in a negative way. And I don't see any grip in Washington. As a matter of fact, I don't even see much of a grip or an understanding on the part of many average, normal people out there in the economy. They don't seem to even know about the situation with the national debt, the interest payments on the national debt, the consequences of the Social Security system, Medicaid and Medicare going forward, they don't seem to realize that these problems are happening because the politicians are simply not talking about it.
What we're witnessing right now isn't normal price action. It's tremors before the eruption. In just a few weeks, silver swung from $35 to under $28 and then rebounded above $30. That kind of volatility scares most investors away. But here's the truth. In markets like silver, it's not a warning sign. It's a pressure gauge. When a market moves that violently, that fast, it means that something is building underneath. And in silver's case, it's a decade of underinvestment, a collapsing supply chain, and a sudden surge in use cases that can't be met by existing output. We've seen this pattern before. In 2010, silver jumped from $18 to $30 in 5 months, then rocketed to nearly $50 the following spring. Why? Because cracks were forming in the financial system, and silver was the release valve. Investors poured in, supply tightened, and a feedback loop took hold. What we're seeing now is eerily similar, except this time the fundamentals are even stronger. Demand is broader, supply is weaker, and policy risk, from inflation to tariffs to geopolitical fractures, is higher than anything we saw a decade ago. So when silver whipsaws in price, don't be fooled into thinking the market is rejecting it. The opposite is true. The volatility is a sign of a market that's too small for the demand trying to get in. It's a sign that the breakout isn't failing. It's winding tighter. And when it finally breaks through resistance, especially that key 35-hour level, the move won't be gradual. It'll be explosive. Because in silver, the real gains always come after the market looks like it's falling apart.
No, I mean, I've looked at that. I've looked at the idea of revenue from the tariffs. That's a non-starter. That the amount of revenue from that is going to be insignificant no matter what the tax rate is. The amount of savings from Doge is really not going to be significant enough to really reverse anything with regards to spending. So those are complete non-starters. The idea that artificial intelligence is somehow going to make us more productive and we're going to be able to grow our way out of it is also, I think, a non-starter, because if you thought of artificial intelligence and you put it into with respect to personal computing technology, cell phones, smartphone technology, the internet, all of these things, they're all great, right? They're all great human ingenuity. They're all going to do great things for the human condition. There's no question about that. But these things take time. They take, a couple of decades to really infiltrate and become integrated into the American economy. It's usually, depending on what technology you're talking about, it's usually about 2 decades. And yes, they do have very, very important in terms of productivity and efficiency. There's no question that those are going to take place, but they're not going to solve the problem of the national debt. I think it's possible, a dictator could sit down and say, okay, this is what we're going to do to phase out Social Security over the next 2 generations. This is what we're going to do to confine Medicare and Medicaid costs to, a 3% growth rate. Here's what we're going to do, to solve these problems. It can be done. It can be solved, but there's no movement in Washington, D.C. to change anything. And, Medicaid and Medicare, they have enormous lobbying organizations in the form of hospitals, pharmaceutical companies, the American Medical Association. These are the people that are making all of the money off of Medicaid and Medicare, and they have powerful lobbying groups, and they're the ones that write the rules of how all this money is being spent. And there's no way in the world they're going to let anything go. And if any politician steps forward and says, I want to cut this, they're going to scream bloody murder and saying you're taking away health care from the least advantaged members of society. Well, that's what we're going to find out about in terms of the least advantaged people in society if all of this goes unchecked in the coming years.
So here's the full setup, and it's more explosive than anything we've seen in decades. Start with the gold-silver ratio flashing recession warnings, signaling silver's historic tendency to slingshot after lagging gold. Add in collapsing industrial mining, where most silver is produced as a byproduct, now at risk as base metal projects face economic pressure. Then layer on industrial demand that refuses to budge, solar panels, EVs, electronics, all devouring silver at record pace with no alternatives in sight. Meanwhile, central banks are hoarding gold, driving the gold-silver ratio even higher and leaving silver dramatically undervalued. Inflation isn't just a backdrop, it's a constant force, draining fiat value and pushing more investors toward hard assets. And while inflation simmers, global tariffs are throwing supply chains into disarray, pushing demand towards silver and amplifying price volatility with every new policy twist. Through all of this, the market is convulsing with wild swings, surging, plunging, and bouncing in tight windows. It looks chaotic on the surface, but it's all part of the buildup. These are the classic tremors before a parabolic move. All of these forces, macroeconomic, industrial, monetary, and political, are converging on one of the tightest commodity markets in the world. Silver isn't just undervalued, it's cornered. And when a market this small gets cornered under this much pressure, there's only one way out: up. The question isn't whether silver will move. The question is how high it will go when the lid finally blows off. Every past supercycle has started with a setup like this, but this time every factor is bigger, tighter, and more volatile. And that's why $500 silver isn't just a wild guess. It's a logical outcome when pressure meets ignition.
Yeah, Austrian economics is the modern version of classical economics. The early Austrian economists fixed some of the problems that they had back then in terms of supply and demand, opportunity cost, comparative advantage, all of the basics of economics. So it's logical, deductive, theoretical economics that a lot of people call common sense, but it's really rigorously scientific. And it has a very long tradition back into 1870 and really going back even to like Aristotle and the medieval monks. So, I mean, it's a long-standing tradition, but we're still the smallest group of economists. I mean, we're still a very small minority. But one of the things I did in my 2018 book on the skyscraper curse is the second half of that book looks at those same episodes of the skyscraper curse, like the Great Depression, like the Panic of 1907, like the stagflation of the 1970s, and even the Great Financial Crisis. The skyscraper curse reared its ugly head at those points in history, but also Austrian economists stepped forward and actually predicted these crises. Now, they were not looking at skyscrapers, they were looking at the Austrian business cycle theory that was pioneered by Ludwig von Mises, Friedrich von Hayek, Murray Rothbard, and many others. And it all centers around the Federal Reserve and its interest rate setting policy, but it's been very helpful. Austrian economists have been able to make some very accurate, timely predictions about the major crises in the economy. We are not very good at predicting the short-term movements in GDP or, minor corrections and advances in stock markets or gross domestic product. But our theory does tell us when things get abnormal, when they get out of the channel, and when people need to beware and to protect against what the Federal Reserve has been doing to them unknowingly. That's another area where, 90% of Americans don't even know what the Fed is or what they're doing or how they're adversely affecting their lives and our economy, their businesses, their investments.
Everything we've covered leads to one simple truth. Silver's explosive breakout isn't a fantasy. It's the direct result of economic fractures, industrial pressure, and monetary misalignment all converging at once. The $500 target might seem outrageous today, but so did $50 in 2011, until it wasn't. What we're witnessing now is the early tremor of a supercycle unlike anything the silver market has seen. And when it hits, it won't just catch retail investors off guard. It'll force the entire financial world to reprice what silver actually means. If you've made it this far, you're already ahead of the curve. But awareness is just the first step. Now is the time to stay alert, dig deeper, and position yourself with clarity, not fear. Because when silver begins its parabolic run, it will move too fast for second guesses. Don't wait for the headlines. By the time the world wakes up, the real opportunity will be gone. Subscribe if you want to stay ahead of the curve and catch the next wave before it breaks. And remember, none of this is financial advice. Speak to a licensed professional before making any investment decisions.